Hello everyone, welcome to this Friday webinar. My name is Kamal Manocha. I represent PMS AIF World. We have been doing, a lot of webinars with thought leaders, industry experts, fund managers with decades of experience to deep dive, understand, a lot of, I would say, complexities of equity markets. The one which is in front of us is the rising valuations of mid and small caps. So we thought of doing, this Friday webinar with relatively young fund manager, the one with around 15 years of experience and who basically is a research analyst, who is a proper fund manager and not just a thought leader. And that is where we thought of inviting Himanshu Upadhyay from O3 Capital. Himanshu brings with him pertinent experience to discuss this particular topic that we have thought and conceptualized for this webinar, which is how to build a low P and high growth portfolio in small and mid caps, even at current levels. There are a variety of perspectives and views that always operate in the market. Most fund managers I have seen, have been keeping the flag high that despite high valuations, it is possible to construct a portfolio and it is possible to keep seeing how returns can be, made even in the space of mid and small caps. But obviously, it is important to understand all that with logic, with numbers, and that is where we have thought that we'll do this presentation with you, Himanshu. So welcome to this Friday webinar. You have first 30 minutes to talk about your thoughts on the topic, and then we'll do Q&A in the second half of this webinar.
Yeah, hi, good afternoon. We'll take you through first 5 slides, which is very brief on what are our thoughts, okay? And how are we looking at the markets and what have been our learnings or my learnings over last 15 years in the market and what I have learned from the history in the markets, okay? First of all, Kamal, can we take the first slide? Yeah. So the first thing is what the greats have said, okay? And what is our thought on this part? Our view is timing the market is a very, very difficult and very few people have succeeded over a long period of time. And we believe our focus or our philosophy about investing is to search for very good companies run by a management having a good execution, buy them at reasonable prices and sit with them for long period of time. And what we have seen is there will be certainly some corrections, but if you want to make large returns in companies or small cap companies becoming large cap companies, you'll have to sit with intermittent corrections also. But we should not get disturbed by that thing. Once, if we are confident on the quality of company management and at the prices what we bought, okay. And how has it helped us? I'll say that since the launch of this special situation product, we have sold only one company from the portfolio in last 2 years, okay. So that is the way what we are thinking, that whatever companies we want to buy, we want to sit for a long period of time, okay. We'll take the next slide where we are talking about how the markets are and what has been our observations on, especially on the small cap side, okay. Yeah. So Nifty small cap index, if we look at it, it seems it has gone very high. But if you look, and why we chose Nifty small cap 250 index, the reason was it is much wider. It has a much wider representation of small cap companies, okay. And it started from 2016 onwards, the index. The index has given 17% CAGR returns in last 8 years. But if we look at it from the peak of 2018, the returns have been 13%. And if we look at the bottom, around January 2020, why we are taking January 2020, it was already 2 years of bear market in the small cap space. And from there, the returns have been 39%. Okay. But our observations have been that even if you invested in certain companies in 2018, which were available for cheap valuations, had good management execution capabilities, and a strong business model, the returns were far ahead of the markets, okay, or far ahead of the benchmark return, which is 13% CAGR for BSE small cap, okay. And as a small cap PMS, our focus is to build a portfolio of companies, 15 to 20 companies, which can do well over next 4 to 5 years or even longer than that, okay. The peculiarities about small cap indexes, and just to compare with Nifty 50 or large cap indexes, is it is far more diversified, okay. And diversification is not just in terms of companies, but even the sectors and industries to which the companies are from, okay. So if you look at it, the large cap index, 84% is from the top 10 industries, and in a small cap index, top 10 industries cater to only 58% of the market weightage, okay. Similarly, in case of the sector weightage, the largest sector's weightage is 35% in Nifty 50, which is large cap index. And if you look at it, small cap, it is around 23%, okay. So the weightages are also much lesser for the sectors which are representing in this space. Now, what is the benefit of having such a wide coverage is you get an opportunity to play much wider number of industries and companies from those industries, okay. So the universe is not very small. The universe is much larger for a small cap index, and the overall universe is not catering to only few industries, okay. It is catering to much larger number of industries, okay. And as a small cap portfolio managers, we are able to participate in many businesses which are not present in the large cap space, okay. And some of these companies may be facing challenging times or are yet to come out of that downturn, okay. And that is an opportunity for us, okay. Our focus is to, in special situations, is on companies which are at early stage of growth and where the operating parameters have just started improving, and the improvement in operating parameters is not fully reflected into the P&L, cash flows and balance sheet of the company. And the benefit of this is that if the improvement is not yet reflected into the profit and loss, balance sheet and cash flows of a company, the probability of getting those stocks cheap is also very, very high. And if you are able to build a strong portfolio of companies where the improvement has not yet completely reflected into P&L, and which you are expecting over next 4 to 5 years, you can sit with those companies for a very long period of time, okay. And that is the way we look at the situation currently also. Now, which are the sectors which we like, and what are we thinking, or where the opportunities which we are seeing, okay. So few sectors where we see opportunities and still a lot of scope is there. One is shipping, especially shipping and offshore business, okay. And we have a company like Great Eastern Shipping. And what special situation, what we are seeing, or why we are expecting a substantial growth rate in the profit and loss and cash flows, is the demand for ships has increased quite materially because of war in Ukraine. Crude oil is not flowing into the Europe through the pipeline. It is getting shipped through the ships. The second thing is the weather issues at the Panama Canal, or there has been a drought in those regions, which has led to disruptions at Panama Canal. And again, the ships have to cross the whole South America to go from Atlantic Ocean to Pacific Ocean. and again terrorism at the Suez Canal end. Okay, so this is a huge disruption, and the ships have to go longer distance. Now with higher demand, we are not seeing supply of new ships to increase. Okay, or because new ship to get built will take 2 to 3 years. Okay, until that period of time, we see this situation to remain like that, and demand supply will remain unbalanced, and the companies in shipping business will have a very good period of time. Okay, so that is one thing. And second thing is, again, when the crude prices were low, nobody invested in offshore side of the business. The company also has an offshore business which is improving. Okay, and what we expect is over next 2 years, all rigs and support vessels will get chartered at higher rates. Okay, and which will start impacting which will lead to better results in the P&L over next 3 to 4 years, especially on the offshore side. Another big opportunity what we see is that we are seeing the new education policy is getting implemented, and it will not get implemented just in 1 year. It will happen over next few years. What it does mean is that the syllabus for schools will change, and new syllabus will be, or new content is getting developed, so that our education system is also in line with the developed countries' education system. Now, the biggest challenge for publishing companies is the second-hand books market. Okay, and as syllabus changes and new content gets developed because of syllabus change, the second-hand book market becomes redundant, which is 50 to 60% of the market. Okay, and the publishing companies should have a very good period of business for next 4 to 5 years during the change. One more thing which is helping this sector is the price of paper, which had increased quite significantly because of supply disruption, have started falling. And the price of paper peaked in CY22. And what we are seeing is the prices of paper have started coming down. The raw material for education publishing companies is paper. And once the raw material prices fall, we expect significant improvement in the profitability because of fall in the price of paper. Okay. Other sector what we again like is residential real estate business. We find that regulations have been in place, or new regulations have been put in place, like RERA, focus of government on reduction of usage of cash, and people having burned their hands during the last upcycle, with many not so disciplined builders are wanting to buy now from more organized players. What we are seeing is that organized and more disciplined players are getting to gain market share from the unorganized players. Okay. And second important thing which we saw was during the very long downturn in real estate business, we felt it was something like a Samudra Manthan in that whole industry. Okay. A large number of players who were present, who were not so disciplined, had a poor balance sheet and had to move out of the business. Okay. And we see very few players have come out with good balance sheet and a brand which is respected by the customers and the channel partners. And we expect these companies to gain market share over the unorganized players. And the growth which is happening in this sector, these companies will benefit. Okay. The last and most important thing is the revenue recognition for a real estate company happens when the occupation certificate is received by the builder and the key is handed over to the buyer. Okay. So whatever sales is happening today is not yet reflected into the profit and loss and the net worth of the company. So what is getting sold today, or what was sold in 2022, 2023, will start getting reflected into FY25 onwards. Okay. in their profit loss and the net worth of the real estate companies. Okay. So it's a lagging indicator, the profit and loss and balance sheet. And we are expecting substantial improvement in those numbers in future. Okay. And generally the upturn in real estate is not in 1 or 2 years. It lasts for 4 to 5 years. Okay. And our expectation is the upturn in this sector will also remain for few more years. Okay. One more sector where we are very confident on, or what we like, is financial institutions which are into secured lending space. Okay. Somebody like JM Financial, Mars, DCB. Last few years, especially after 2015, we saw there was a euphoria on financial or lending space, or companies which were into the lending, and the valuations were not right. But what we have seen is, because of COVID, NBFC crisis, slowdown in the general economy, a lot of problems which were there in that space have got cleaned up, and the NPAs have reduced at the system level, especially on the SME lending side. And we also know again here that which are the good people who have been lending, or which companies have good lending practices, both on the banks and NBFCs. And the valuations also, after a very long period of time, are cheap. And we believe over next 4 to 5 years, these companies will do fairly well, not just in terms of business, but also in terms of price movement. Okay. But one thing which I'll again say is, our focus is 4 to 5 years of time frame. Okay. We are not looking at anything from a quarter or few quarters perspective. One other case I'll add on is agrochemicals. Okay. See, last few years, one sector which was doing pretty well was commodity chemicals. Okay. And the impact of that rising commodity chemical prices was the companies which were into the formulation space, the margins were continuously reducing. Okay. Now what we are seeing is that the commodity prices have started falling, and the companies which are into the formulations space will get to do better because of the fall in raw material prices. Secondly, last 2 to 3 years have not been very good in terms of rainfalls. Okay. We expect that situation to also start improving from here on, and hence our thought process is that companies which were negatively impacted because of poor rainfall and fall in higher raw material prices will start doing well over a period of time. Okay. And could have a pretty good next 4 to 5 years. Okay. So the focus again is to look at companies where you are searching, where we believe that operating parameters are improving, and in next 4 to 5 years, we expect the growth to be pretty good because of change in the industry or the prospects of that particular company, and should lead to significant improvement in the profit and loss and cash flows. And again, after that, it will start impacting the enterprise value or the market cap of that particular companies. So that is, in a nutshell, our thought process, and why we think small caps can do well, or what is the interesting part. We think the number of companies and sectors which are there in small cap are not present in, or do not have a representation in large cap, and hence the universe is much wider. Not all sectors tend to do well at the same time. What we have generally seen is sectors do well, okay, and companies from that particular sector will rise. Okay. So what we are seeing is companies from infrastructure, capital goods have done pretty well in last few quarters. And yeah, some of those companies, even in small cap, have risen. Okay. But there are various other industry sets which are yet to see the improvements. Okay, and our focus as a bottoms-up portfolio builders is to look for those type of opportunities which are yet not appraised in the market, or where are not appreciated in the market, and where we see that significant improvement in market cap will be there. That's a brief what I'll say. We'll take on more questions which will be more helpful. Okay.
Sure, Himanshu. I think this was a very in-depth presentation. So let's know now, maybe discuss about few businesses to give the context, to whatever I would say concept that you have discussed. So let's talk about, for example, very interesting thing that you discussed with regards to education sector, where syllabus is going to change. So obviously, this sounds to be interesting, and I see that yes, education as an industry is a very brilliant idea. But you will tap this through what kind of businesses? You may want to take a few names also. Obviously, we are not giving any advisory to anyone. Everybody has to take their own decision, very, I would say, in an informed way by consulting their respective advisors. This is just for education purpose that we are discussing this. So go ahead.
Yeah, so we like a company which is Navneet Education, which has a presence, significant amount of revenues, which are from school publishing. Okay, and they have a very strong presence in Gujarat and Maharashtra, and where the new education policy implementation till class 2nd is already happened. See, generally the implementation happens stage by stage. Every year, next 2 to 3 classes, the syllabus gets changed. So nothing happens in one go. The things or the complete change in syllabus happens over 4 to 5 years. Okay. They also have a presence in CBSE schools through an acquisition what way they did few years back, and they are present around 7,000 schools in CBSE out of 31,000 schools which are there for CBSE. Okay, and this is still a growing business for them. Okay, so and the biggest change or the earliest change is happening in the CBSE schools and then the state boards. Okay. And what we like is their disciplined way of working and significant focus on the cash flows, what they generate. Okay. And hence we like this company. Means obviously the large theme is the change of syllabus which is happening. Sure. The second is their strong presence in these 2 states, and they have entered CBSE, where also a lot of changes happening.
Sure. And what about agrochemical space? What kind of companies are you looking in agrochemical space?
See, the company what we had or what we have currently is Dhanuka Agrochemical, and other was Sharda Agrochemical. Okay, they both Dhanuka is majorly into the front end branding type of businesses. They are into the formulations space, and they are not into the key raw material manufacturing for the agrochemicals. Okay, so they have in-licensed chemicals. 50% of their portfolio from MNC companies. They have around 14 tie-ups with MNCs, from whom they get the key raw materials and sell their products under their own brand name. Okay, so they are not into the raw material manufacturing. They are majorly into the formulations space. Okay, they build a brand and sell to their customers. Okay, so what is happening is, as the raw material prices are falling, they are getting the benefit because the raw material for formulations, the price are falling, and hence we have seen improvement in their margins, and we think the improvement is sustainable. Okay, and the volume growth is also happening for them. So companies like Dhanuka and Sharda is having some amount of tough time currently because of fall in the chemical prices or agrochemical, which is leading to inventory write-off. But it is a temporary situation, which we expect will improve over in next few quarters. Okay, as again the chemical prices start bottoming out. But again, Yeah.
Sure. So this is quite interesting names that you have kind of shared. I would like you to now throw more perspective on how comfortable are you with the valuations. For example, the two stocks that you talked about, Navneet Education and Dhanuka Agritech. If I say their P's are between 20 to 25, so 20 to 25 P, how do you want to substantiate this in terms of current levels and expected growth? Because the topic of this webinar is identifying low P businesses with high growth, and you have discussed these two stocks as an example, right? So how do you substantiate this?
No, see, once the revenue starts improving, okay, and the raw material prices start reducing, okay, the both those companies what we spoke about, we expect the raw material prices to fall quite significantly, okay. And once that happens, and higher scale gives you again economies of scale, both of these things will lead to much faster improvement in the profits of these companies, okay. And hence we think that 20 times price to earning is still subdued or cheap valuations, okay. We think because of the improvement in margins and the revenue wise, the profitability will improve much ahead of the revenues, okay. And that is the whole thought process with which we are working on, okay.
So if I was to kind of give this statement that small and mid caps, though they have done really well in last 2 years, they are like looking expensive, and people are thinking, yes, perception is that large caps are like less expensive, they have done relatively kind of inferior to mid and small caps. But in year 2024, market is going to give a new learning. Market is again going to bring a new surprise, and that surprise is that large caps will actually see correction and small and mid caps will not see correction. Or the correction, if at all, which is obviously a characteristic of equity market, whenever it will happen in future, it will be more in large caps and less in small and mid caps. So what will be your remark, what will be your comment to such kind of a statement?
See, the way we look at it, or my personal view is, the stocks which are more expensive and where the growth is not meeting the street expectations will fall, okay. Whether it is small cap, mid cap, large cap, okay. One important thing what we have historically observed is birds of a feather flock together, okay. And what we have seen is the whole sectors tend to do well, okay. When defense companies were not doing well, it was whether small cap, mid cap, large cap, private, PSUs, everybody was available at a very cheap valuation. Once the order book started improving and growth started happening, all companies in that space did well, not just in P&L or balance sheet, but also in terms of valuation, okay. So our observation is that over a period of time, it will depend upon what the stock prices are and what will be the growth in their numbers. If the growth is much ahead of what valuation was reflecting in the stock prices when you bought it, then the stocks will move up. Otherwise, they will fall if the growth is not meeting the valuation with which you are buying, okay. And another example I'll just take on is, we stated about lending businesses, okay, or we again like a lot of lending companies now. For last 5-6 years, lending businesses have not done well, okay. Whether it is large cap, mid cap, small cap banks or financials, NBFCs, all have not done well, okay. And what we are trying to explain is that small cap as a market is much more diversified, okay. And you will find those type of sectors which are doing well even in small cap companies, okay. And we expect those companies to do pretty well, okay, where the valuations are cheap and the growth is going to be good, okay. So we are not looking about large or small or mid cap. We are looking about at what is the valuation, what can be the potential growth in next 3 to 4 years, and are those companies going to be able to execute what they are speaking of? And if they are able to execute, obviously it will get rewarded. Okay. So that is the whole thought process.
Sure. So, what are those sectors or those businesses, where you see the story is kind of, overdone? I'm talking about maybe, say PSUs, or, we have seen rally coming in, a lot of real estate as a sector, right? Though you talked about real estate as a sector, which is optimistic from your point of view. But let's understand the other side, which looks to be now red hot, and where valuations have run beyond the fundamentals, as you mentioned, and could be the reason for a correction which is coming on the way.
See, corrections will come when growth disappoints. Okay. Somehow my learning is corrections don't happen just because valuations are expensive. Okay. In last few years, what we have seen, it is generally the earnings will be poor, and hence the valuations will come off. Okay. But where we find the biggest discrepancy in terms of high valuation and low growth, I would say, is still consumption space, where we find that valuations are cheap, valuations are expensive, but the growth is not yet coming about. Okay. So there is a risk what we feel. The second place where valuations have run up and we still believe the growth can be reflected in positive direction would be infrastructure, capital goods space, and again real estate sector. Okay. See, the cycles tend to last for 4, 5, 6 years. Okay. Whether if we look historically at chemical sector or even the real estate boom, it started in 2001, 2 onwards, was there for next 7 to 8 years. Okay. And all these companies did well, especially which were into the capital goods space, real estate, infrastructure. Okay, so we have seen the 2 years of uptrend, but we think the momentum will continue with healthy order books. Okay, we see most of these companies have order books filled for next 3 to 4 years. Okay, and hence they have to execute and get it into the revenue stream. Okay, so that space, even if the valuations look stretched or are looking expensive, I think the growth will continue in those type of companies. Okay, and yeah, these are the two spaces where the valuations are rich. Okay, but the difference is in one place the growth is not happening, the other place growth is there.
Sure. So you are a special situations fund manager, Himanshu. Let's talk that particular space in that approach. How does that look in terms of its attractiveness or the potential or a possibility, or I would say opportunity in terms of, creating a portfolio or adding companies to the portfolio? If you get fresh money, are you able to find out enough opportunities in special situations style of investing or not? Are you thinking of kind of sitting on cash? If your existing investors are giving you money as a top up money, are you kind of deploying that in the existing names reluctantly, or you're sitting on cash, or you're kind of saying no to new money at these levels? How is that space looking from all these perspectives, which I've given you a lot of ways to answer this particular question?
No, see, one thing I'll say is that we are a bottoms up stock selectors and portfolio builders. Okay, most of the portfolios are built from scratch. We don't run a model portfolio. Every month we have a portfolio which we build, and all clients who come into that month will get aligned to that model portfolio for that month. Okay, so we had a pretty good run in last 2 years, and that was because of capital goods which were there. Okay, so something like APAR or Action Construction and all those things. Okay, so in the older clients we continue to hold them, but for newer clients we are not buying them. Okay, so that is one aspect which you need to, or which I would like to tell everyone, that the portfolios are built from scratch. Okay, they are not standard model portfolios what we do. The clients who came earlier can have a substantially different portfolio than clients who are coming now. Okay, and the sectors and industries can also be very different than what they were having. Older clients are having, and the newer clients will have. Okay, now that is one aspect. Okay, the second is have markets run up. I agree with you. Markets have run up. We used to take earlier 2 months around to get invested, around 80% in the client's money. Now it is taking around 3 months, and to reach 75 to 80% of the money what we receive from the clients. Okay, so that is one part of the thing. The deployment is happening much slower than what was happening, I would say, 1 year back. So that is the other change which we have seen. We are not going to invest, or we are not investing clients' money because the client has given us money. We generally tell the clients, whoever are coming to us, that the portfolios will get constructed over a period of time. And especially in these type of markets, we will take 2.5 to 3 months. Okay. Opportunity now, so that is on capital deployment of the clients. Second is, are opportunities available? See, the beauty about small cap market is there are wide number of companies. Okay, and every quarter you will see that certain industries or certain sectors may not do well, and that keeps on giving you opportunities. Okay, and in every industry you will find 1 or 2 or 3 really good management who are focused on building business in the right way, and in a way they don't take too much risk on their balance sheet and cash flows. Okay, and who have an ambition to take their company much ahead from a 5 to 10 year perspective. Okay, so those are the companies what we are looking at, and yeah, those type of companies are available. Okay, they are small cap because the overall market for their product is sometimes small. Okay, it is not that companies are small because they are not efficient. Okay, I'll just give you an example. Okay, we played in 2022 a company called Sangvi Movers in the portfolio. It's a small company. It's a small cap currently also. The company is market leader. Okay, it is among the top 5 crane rental companies globally. Okay, and it is the largest crane rental company in the country. And the total crane carrying capacity for the company is equivalent to the next 3 players in the market. Okay, but it is small cap because the overall size of the business is small. But they have done pretty well with continuous improvement in their profitability, focused on capital protection, having low debt. So that is the type of companies what we are searching for, and where the opportunity is coming up because of a change in the sector or change in the overall nature of industry. Okay, and the companies are small because of the size of the business.
Sure, Himanshu. What are the views that you want to present regarding electric vehicles? Is that having any position in your current portfolio? Do you see any special situation emerging in this segment, or from the other maybe value style of lens or growth style of lens? Are you wanting to give any ideas to the audience today about this particular sector or any businesses within this sector?
See, the focus for us is to invest with a 4 to 5 year time frame. Okay, and when you look at electric vehicle as an industry, okay, with a 4 to 5 year time frame, we are not it is still not very clear which companies will gain market share in terms of auto companies and who would be the leaders. Okay, and hence for us it is still very new to invest, and we are not focused on churning the portfolios. Okay, and there is still no clarity on the winners. once the clarity is there, and in the next cycle we may play. Okay, but you asked on auto ancillaries. I would say we have two auto ancillary companies, which one of them does provide to the electric vehicles also, which is Suprajit Engineering, and the other is Menon Bearings. Okay, but their business is yet to start getting positively impacted, because as their significant proportion of revenue is in exports to Europe, US, and Japan for both these companies. And those three economies are not doing pretty well currently. Okay, and there is a margin pressure for Suprajit in their exports business. Okay, but those are temporary challenges, and we expect that growth to come back for these companies over once these economies start to do well. Okay, but are we playing very focused EV company? Currently, no, we are not playing, as we don't have that much of clarity on who are the winners. Excuse me, I am not able to hear you.
Sorry, I was on mute, Himanshu. So I was saying, there is one question on the chat. How do you manage large number and large set of portfolios if you're customizing these portfolios, say every month or every quarter or every 6 months as new clients come?
Can you repeat it? I just missed your part.
I'm saying, you are basically, you said that at O3 Capital, in your special situations PMS, as new opportunities keep coming in and older opportunities, keep becoming expensive, new clients will have a different portfolio than an older client, which obviously over time will converge. But how will you manage, this across large number of clients? How is that management part done?
See, one thing is the portfolio is not managed by just me. We have a team of people and analysts who are also looking at various companies. Okay, so the portfolio management is a team process. Okay, or what we look at. So the analysts also give a lot of ideas on the companies which are there, and people are tracking more, or everyone is tracking those companies, the whole team. So we are looking at those companies, and that is for older clients also, those companies are being looked at. Okay, it is not that we have stopped looking at them. We are finding the growth is there, and the valuations are not very cheap, and hence we are not buying into them. But for the newer clients, we are looking at stocks which are really cheap and where we think still a lot of growth is possible. Okay, so that is the way we are trying to build a portfolio and look at the companies. Okay, and generally the companies what we are having, if you look at the portfolio, they are not pure commodity companies. Okay, they will generally be in a niche segment, and they are market leaders. Okay, and because of them being market leaders and in a niche segment, and clean balance sheet. Okay, one important thing what we look at it is balance sheet should be very, very clean, and the credit rating should be strong. So no company with a credit rating below BB we choose, and where the debt equity is higher than 0.5 times. Okay, so all the companies would have a debt equity ratio lesser than 0.5. Okay, so why I am talking about these two parameters? If these two parameters are really bad, that is the sign to sell out those stocks. Okay, but most of our companies are not showing any of these signs. Okay, where debt equity is I would say increasing, or credit ratings are going on the downside. What we are currently seeing is most of the companies, the debt equity is reducing and the credit ratings are improving. Okay, and hence we remain confident on whatever we are holding, both old and new clients, that the prospects are going to improve and are still improving. Okay, and so that is the whole thought process. Okay, and a lot of risk management happens at the earlier phase or at the initial phase of stock selection. Okay, so that we don't have to churn the portfolios quite often. Okay, and if you want, can I explain more on my risk management processes?
Yes, absolutely.
See, there are few things what we look at, and I think are very, very important from risk management perspective in small cap space. The general reason why we have seen small cap companies fail is because of high debt to equity and poor credit rating. The way it has impacted is, or the impact of it is, when the downturn is there, most of these companies are not able to roll over their debt or raise incremental capital. And hence, we want companies whose credit rating is at least double B or above, and their means credit rating is double B above, and credit rating is debt equity is less than 0.5. Okay. The other important thing what we want is promoters should have a significant skin in the game. The average promoter shareholding in the companies what we own is around 64%, and no promoter has more than 0.2 times shares which are pledged. Okay, we want promoters should have a minimum number of shares pledged. At the general preferences, they less than 50% of their shares should be pledged. The way we look at the pledging of shares and low stake is, if the high number of shares are pledged, it means that the promoter's personal balance sheet is weak. And when his personal balance sheet is weak, he would do something which will not be in the interest of the company, or the incentive for the promoter would be to do something which is not in the shareholders' interest. Okay, and as his first focus would be to reduce his own debt. Okay, and that is the reason why we look at this parameter very closely. And wherever we are seeing that the promoter's pledging is increasing, or he is reducing his shareholding quite significantly, those type of companies we generally do not buy in the initial phase itself. The third important parameter, okay, is we don't want companies whose business models are too diversified, or business models keep on changing. Okay, if the business models keep on changing, it will be very difficult for us to really to have clarity on what can drive that businesses. Okay, and if we don't have clarity on what is driving the business, it won't make sense for us to sit with the company for 4 to 5 years time frame. Okay, so those are the things what we start with in the very initial phase. If we are confident on these parameters, then only we'll look at a company to buy. And once we are confident of all these parameters, we'll like to hold a company for a longer period of time frame. And just to give you more detail, the average credit rating of the portfolio is around E plus. Okay, and the promoter shareholding, the average promoter shareholding is around 62%. Okay, so those are important parameters, especially from the risk perspective.
Sure. I would like you to cover, one particular business, because you being a fund manager and with a proper background of research analyst, which I have been seeing has been part of many portfolios, but is not performing, which is Loris Labs. It's a stock, which has been part of businesses, but has been part of portfolios. But if you have some perspective, I have been getting, on my personal chat, few requests from few clients, because this is a stock which really did well in the last bull run. But if you have some ideas, share your views.
See, See, all API companies did pretty well in the last upturn because of COVID. There were a lot of supply disruptions, okay, and everybody wanted to have the APIs, okay, or the key raw material. And the prices of those raw material also increased during the COVID period, okay. Now what we are seeing is that the raw material situation has improved quite materially. The supply chains disruption has reduced quite materially. And the impact of this has been that a lot of raw material prices have reduced, okay, because of all these things, okay. Over a period of time, companies will do well, okay, in that space. But currently there is a glut, and because of which many of these companies are having poor margins, okay, or poor returns. But it will take patience. I don't want to name any particular company.
No, sure, that's absolutely fine. So, when I took this name because, you were talking about your risk management and, your entire overall process. So, when a company goes through such a phase, how do you kind of, understand when to exit a stock? Or, if you want to share with some examples in the past where you exited a stock at maybe right time, or I would say an example of maybe a failure which gave you a learning where you kind of did not exit at the right time in this particular context, because we know there are today investors who would be holding even HDFC Bank for long or Reliance Industries for long, in the large cap space. These stocks have not done well in last 3 years, but these are popular stocks. But we are covering for mid and small cap space. In that particular space, I took this example for you to cover this particular aspect.
See, there are two reasons to exit in a stock for us, or very important reasons, okay. One is the valuations became very expensive, and the way we look at it is the stock valuations if start reflecting next 2 to 3 years of earning. And sometimes what happens is that the PE ratio may be low, okay, because of some exceptional reason the earnings have increased quite materially, okay. So you need to first adjust the earnings, okay, like in terms of chemicals, or it will be over a period of time even in capital goods, okay, where the margins have started improving. But we need to look at across the cycle how the margins are in that particular industry, okay. Let's say a textile companies, what the margins were and where they are today. So you need to, our focus area is where the margins have been, okay, historically, how far away, and are we already paying for next 2 to 3 years of growth, and the margins may not sustain if for those, then how the valuations will look like, okay. And hence at that period of time you need to sell out, okay, if you are seeing that the margins have already increased quite materially, and the growth is also reflected into it, okay. So one stock which we exited, let's say in last 1 year, and since the inception of the product, it was a Triveni turbine what we exited, okay. The reason why we exited was we believed the valuations have turned too expensive for the company, and even if the company does doubling of its profits, okay, in next 3 years, my price to earning was going to be around 45 times, okay. So we exited around 450 rupees that particular stock. So that is the way what we are looking at, okay, that if the valuations start reflecting very high growth rate, and that is the time to exit, okay. And one important thing is business is mature, okay, and not all businesses or at the time of if you start seeing maturity, the companies can keep on growing for 18-20% permanently, okay. Because if that happens, the companies will become larger than the economy or the market where they are operating, which cannot happen, okay, because the markets themselves will grow by 6-7%, okay. So we need to understand in the valuation part, that what growth is getting reflected into the valuation. And if the terminal growth rate is substantially high, let's say sometimes 6-7% type of growth is getting reflected into the terminal numbers, those would be the time when we would like to exit. Okay, the focus for us is cash flow based valuation and what is getting reflected into the stock price. Okay, and if we find the growth, very high growth rate is getting reflected not just in next 3 years, but beyond 3 years, and even in terminally, people start expecting 6% type of growth and beyond. Means theoretically, beyond 3% is you need to sell. Okay, or I would say the textbook says 3% is very high.
Sure.
If we start seeing terminal growth rate of more than 3% in the valuation, we like to sell off.
Sure, Himanshu. So we are moving to the last 5 minutes of our discussion. I'll just kind of set the context for the last 5 minutes of conversation. So Himanshu, we have been discussing a lot about the conceptual aspects and fundamental aspects, and we have done, I think, full justice to the topic of this webinar today. And why we keep doing webinars every Friday is because we want to kind of ideally understand and spot some of those smaller or less known PMS which are doing really well. And that is the reason we kind of thought of doing this webinar with O3 Capital as well, because I know O3 Capital's performance across PMSs is good and quite consistent. Though industry talks about more popular names and industry is more distributing more popular names, but we as a platform, because we are unbiased and we want to understand and properly kind of deep dive a strategy mathematically, statistically, and then understand it by hearing from the fund manager. So that is the context, and I'm setting this context for you to kind of talk about your product now in terms of its past performance and what is your satisfaction with your performance, say, in year like 2023. Let's talk recent stuff, and that is something which is the last segment of this particular conversation, which I am giving you the full 5 minutes for you to kind of now discuss from this perspective.
So thanks, Kamalji. The portfolio performance as of 31st December 2023 in last 1 year has given 58.72% returns. And since inception, which is 1st August 2022, the returns have been 57%. So returns have been quite good. And the reason majorly for the good returns was the stock or the portfolio was built from where bottoms up. And we were able to look at things slightly ahead of others in the market, or others means capital goods, infrastructure, real estate, hotels, which or travel and tourism, what we played. So those were the themes which have done pretty well. Okay, and that has been helpful for us. Okay, so from when we started this product, the focus remains to look at opportunities from 4 to 5 years time frame. Okay, not from just a few quarters time frame, and people who can execute it. Okay, so most of the companies what we have in the portfolio, whether it was Apar, TD Power, Ashiana, Colte, Shobha in real estate, crane companies like Action Construction, Sangvi Movers, all these companies had a proven track record. And the average age of the companies in the portfolio is something like 41 years. So it was not something that the companies which were chosen were just very new, some IPO we have participated. Generally, we don't participate in any IPO. The thought process is to invest in companies which have at least 10 years of track record or a listed history of 10 years, which gives us a lot of data points on how the business has behaved in last upturn and downturns, and were the management able to come out very carefully and without much issues in the downturn. And if we are confident that those companies can come out of any challenge very strongly, okay, and gain market share. Those are the type of companies what we try to play at, okay. And those companies did pretty well, okay. So with 41 years of experience, most of the companies came out very strongly, and that really helped us give this performance, which is 56% since inception in around 1.5 years, okay, and 59% in 1 year. So that is the major driver for our strong performance, okay. And yeah, we did not trade also, and we invested in the companies, proven track record, and have sat through them, okay, for last 1.5, 2 years in those companies, okay. That is the most important thing. What we have also learned historically, that small cap company will become a large cap, not in one cycle, okay. It happens over 2-3 cycles, okay. And you have to sit with the company for 2 to 3 cycles, which means you may have to sit for 5 years, 6 years. And you will be able to sit with the company with 4 to 5 years if you are confident before buying the company, okay. And you have patiently worked in researching those companies, okay. And researching means looked at those companies for significant amount of time frame. You understand the drivers of the business, and are those operating parameters starting to improve? And if those operating parameters are improving, what will be the impact on profit and loss, balance sheet, cash flows, okay. That is the way the whole process and we have followed in building this portfolio, and that has helped us give this track record, okay. So when we were buying into real estate in 2022, what we were seeing was the sales were happening, debt was continuously reducing, the inventory on the balance sheet of real estate developers was continuously reducing, okay. These were 3 signs which helped us say that the sector is going to face good times, and the companies which are there will gain market share and will grow multifold over next few years, okay. Similarly, in case of capital goods, what we were seeing was the order book was continuously improving for these companies, okay. In terms of power, everybody was speaking about electrification and renewable energy, okay. What we saw that it will be a big change which is going to happen, and a lot of capital good companies will benefit out of the orders which will come, okay. It will not be just windmills, but transmission, distribution, small turbine, small generators manufacturers. So all these companies will benefit, okay. And that helped us enter those companies much earlier, okay. And currently also what we are buying are themes which we think can do well over next 4 to 5 years, okay. So that they are trying to buy companies with improving business parameters or operating parameters is the focus area for us, and strong management, okay, who will execute what we are thinking and what they are also thinking, okay. So see, when you are meeting a management, the focus is also to know where the management wants to take in next 5 to 7 years, okay. And having a good track record is extremely important. So that is the way we are looking at the companies even today. We spoke about Dhanuka Group, okay. If we look at their last 10 years history, their growth rate in terms of revenue, profit, margins, return on capital employed, all have been one of the best in the industry, okay. And it is still a small cap company. So those are the type of companies which we are looking for future also, and not having to overpay for those companies, okay. And a unique business model which is difficult to get replicated, okay. So we think that is the way we will be taking it future also. Some companies may test our patience, but that is fine, okay. It will happen, okay.
Sure, Himanshu. I think it has been really pleasure conversing with you over last more than 1 hour. We have discussed your views, on how to build low P and high growth portfolio in current levels, as well as the performance of O3 Capital's PMS, which is Special Situations PMS, which you manage, is actually interesting. And obviously, last 1 year was conducive, but even in conducive times, kind of generating so much alpha is definitely something which talks about your skill set. And that is the reason I had to ask that question. Again, I thank you, for joining today, and thank you everyone for joining for this Friday webinar. We'll keep this momentum going because we kind of are passionate about learning and passionate about kind of finding out new gems, hidden gems, which are really doing well, and we offer those to our clients with where we find a lot of conviction. We are building our conviction on O3 Capital, and this webinar was a step in that direction. Again, many good wishes to you for your continued, I would say, outperformance. Thank you once again. Have a nice weekend.
Yeah, thanks, Kamalji, for giving us an opportunity to share our views with your esteemed partners. And yeah, thanks to the listeners also.
Pleasure.